All right, let's break down what on earth just happened in the gold and silver markets. It was wild, it was dramatic, and we're going to get right inside the psychology, the headlines, and of course, the hard numbers to figure out not just what happened, but why something like this was pretty much bound to happen. So, if you've been watching the headlines, you know exactly what I'm talking about. After this absolutely massive run up, gold and silver prices just fell off a cliff. It looks completely chaotic, right? But what if I told you this wasn't random at all? What if this was a totally predictable pattern, a trap that snaps shut on investors time and time again? Well, this pattern actually has a name. It's called the laggards trap. And it's a textbook market move where folks who show up late to the party, the retail investors, end up providing the exit liquidity for the pros who got in early. The lesson here is pretty crucial. By the time an investment is screaming from the front page news, the smart money has probably already cashed out and gone home. Those long queues you see, they aren't the guests arriving, they're the cleanup crew. So, how does this trap actually work? In this first part, we're going to break down the mechanics of the trap itself. We're going to get into the psychology of what makes people want to line up for something right at the moment it's about to peak. Let's dig into the anatomy of a market top, because there is a very real reason why the herd almost always shows up late. And it's got nothing to do with luck. It's all about understanding the market cycle and, just basic human emotion. So here are three huge reasons to just stay out of that line. First up, you are the exit liquidity. See, the pros buy low when it's quiet. That's the accumulation phase. Then they sell high to the public when everyone's freaking out. That's the distribution phase. If you're standing in a queue, guess which phase you're in. Second, you're going to pay what I call a frenzy tax. Dealers jack up their premiums when there's a rush. That means you could be down 10% the second you walk out the door. And finally, emotion is just a terrible, terrible investment strategy. Fear of missing out, FOMO, is what drives these crowds. But investing based on headlines is purely reactive, and believe me, the market loves to punish reactive decisions. Okay, so enough with the theory, let's look at what happened in the real world. We're going to flip through some global headlines from the last few months, and you'll see exactly how this trap played out in real time all across the planet. And you've got to pay attention to the timing here. It is absolutely critical. Notice that the panic buying and the longest lines didn't happen before the peak. They happened after. Gold actually topped out in January. But the biggest retail frenzies in Singapore, Vietnam, and China, they all happened in February and March, as the price was already starting to crumble. The public was rushing in just as the smart money was tiptoeing out the back door. And here's the proof, right from the headlines. In Singapore, right after that January peak, demand got so insane that UOB Bank had to extend its hours and then switch to an appointment-only system. The physical lines of people were literally overwhelming their system. And this next one? Oh man, this is a textbook flashing red light signal of a market top. OCBC Bank reported that 2 out of every 3 new customers were choosing precious metals as their very first investment. When the absolute least experienced people in the market are the ones driving all the volume, well, a correction is almost always just around the corner. I mean, you could feel the desperation. In Vietnam, people were lining up before dawn. They were leaving their personal stuff, helmets, sandals, on the sidewalk just to hold their spot in line overnight. Come on, this isn't rational investing. This is pure, unadulterated FOMO in action. And over in Shanghai, it was the same story. Consumers completely pivoted. They were abandoning luxury goods like diamonds, and instead, they were choosing to wait in these increasingly long queues for gold bars. Why? Because they thought it was the only safe asset left. And this was happening just weeks before the price started to collapse. So the pattern here is just crystal clear. The headlines get louder, the queues get longer, and the public rushes in. And this creates the perfect wave of demand for those early investors to quietly sell into, locking in their profits and heading for the exits. So, of course, after a frenzy like that comes the fallout. Let's take a look at what happens when all that retail buying pressure just runs out of steam and the trap finally springs shut. The aftermath has been swift and, frankly, brutal. As of March 19th, gold has already plunged over 4%. That has wiped out a huge chunk of the recent gains, and it's put anyone who bought near the top deep into the red. And silver, oh boy. Silver is always the more volatile of the two, and it's been hit even harder. It's down nearly 9%. That is a punishing drop for those latecomers who were chasing that rocket ship on the way up. So why on earth did the safe haven suddenly crash? Well, the paper market, all the financial contracts, not the actual physical metal, it decided to reassert itself. First, the Fed hinted it would keep interest rates high, which makes other things look more attractive. Second, a stronger US dollar made gold more expensive for anyone buying with other currencies. And finally, traders who had borrowed money to bet big on prices going up were forced to sell when the market turned, which just created this downward spiral. So the big question is, where do we go from here? Well, analysts are now glued to these key technical support zones. For gold, that sweet spot is somewhere between 4,600 and 4,650. For silver, it's that psychological line in the sand between $68 and $70. If prices break below these levels, the selling could get a whole lot faster. And all of this brings us to the most important part, the takeaway. How can you use what just happened to become a smarter investor the next time a frenzy like this kicks off? It really just boils down to that classic piece of market wisdom: buy the rumor, sell the news. What that really means is the time to get interested in something is when it's just a rumor, when it's quiet. By the time it's front page news with pictures of people lining up around the block, the smart money isn't buying anymore. They're selling to you. And this really gets to the heart of the contrarian mindset. The real opportunity is almost never in the middle of a frenzy. It's usually found when the fear is at its peak, when the cues are gone, and when the headlines have moved on to something else. Basically, when nobody wants to talk about an asset anymore, that's probably when you should start paying attention. So, I'll just leave you with this final thought. Right now, the cues are gone. The headlines aren't about the boom anymore. They're all about the crash. Greed has been replaced by fear. So, based on everything we just went over, what does that tell you might happen next?